I very much hope you are watching this video in time because the market is about to go crazy. I'm talking about the first rate cut of this entire monetary policy cycle, and things are gonna get bonkers. So at this moment, as of now, when I'm filming this, we have no idea how big the rate cut's gonna be. We know we're getting a rate cut, but everyone's shrugging their shoulders of 25 bips, 50 bips. Is it good? Is it bad? Is one more good? Is one more bad? And that's exactly what I want to answer. Markets hinge on Powell emulating Greenspan's soft landing. So this entire concept of can we pull off a soft landing hasn't really been seen before by the Fed, but hey, maybe this time's a little bit different. Not that I'm actually expecting it to be. So a day out, as we're heading into this, Fed to cut rates by a quarter point with soft landing expected according to a CNBC Fed survey. Once again, hey, everyone has the thoughts, everyone has an opinion. What matters is actually price action. So let's get into the first question of not this time around, not this specific 25 bips, not this specific 50 bips. Let me paint the picture for you of how Fed rate cuts for the market have played out historically, and this is going to be a little bit shocking. You can see right here, the S&P 500 returns after rate cuts. So we're looking 3 months out, 6 months out, a year out. And at first, it might look a bit 50-50 to you of like, okay, 3 months out, maybe a little bit more red, 6 months out, maybe about 50-50, depending on the year. And then 1 year out, it seems like the green is dominating. And yes, at first, that's a fair takeaway. But there's one thing I really want to point out to you is the months where the 3 months one, where it's still green, most of these 3 months are going to be in the red with the average return at a minus 1.1. But there are a couple of years you could take out because of the old fake out in the basically the yield curve, the 10-2 yields. We know that they were inverted in the negative territory for the longest term ever. And now, once again, we are back in the positive territory. Right here, we're clocking in at a positive 0.043. So what I want to remind everyone is these years where it was 3 months and we were still green, as in 1980, as in 98, these were all times where it was actually a fake out, as in we were negative, it popped back positive and then came back negative. And it was in that fake out of dropping back in the negative territory that in the short term, we actually saw some pops. But then don't forget what always happened the very next, cycle, a couple business quarters later, is it went negative. And then once again, when it comes back up positive, that's when things got rough. So that's why when you see a lot of these couplings of the years where, at first it's green and then the next year it's actually considerably red, like looking at 98 versus 01. We actually saw similar stuff happen in 06 versus 07. So there are fake outs in 2019. So I just want to bring that to everyone's attention of, yes, in the very short term, as in 3 months later, there's a negative skew. But when you discount these fake outs from positive back to negative, then to positive, it's even more of a bearish skew. So basically what I'm saying is if this drops right here, all of a sudden, and if you're watching this over the next couple months and we're back in the negative territory, we might be in another fake out situation where things are actually still pretty freaking bullish, at least within the stock market. But then still be careful of when we recover back into positive. The other way to look at that is if we just stay in this positive territory, most likely going to be associated with unemployment continuing to spike, and most likely going to be associated with the next 3 to 6 months probably having more of a bearish tendency. The other things you should consider are the size of these rate cuts. So right here, you can generically see the difference of the impact of a 25 bips rate cut for the first one versus a 50 bips. So obviously in reverse chronological order, 2019, 07, 01, 98, 95, 25 bips, 50 bips in the middle, 25 bips on the sides of it. Kind of see an interesting trend here. When you get a 50 bips one, 1 year out, 2 year out, 3 year out, 4 year out, all in the red, all associated with 50 bips. Now I'm going to be fair here and say this is only 5 data points, and that's not really enough to make a statistical projection of the things that are about to come. But it is interesting that with the 250 bips in 01 and 07, it was red 1, 2, 3, 4 years later. And then all of a sudden in 2019, 98, and 95, all associated with the 25 bips rate cut. By the time you actually got a year out, we were already back in the green. Now, none of this is a guarantee of how things are going to play out this time around. I'm just trying to, illuminate how things have played out historically, just so we get some math and odds behind this upcoming crazy announcement. What's going to make this whole situation even more wild is the fact that US retail sales unexpectedly increased after upward revision. So at 8:30 this morning, when we were all getting ready for the degenerate trading day, the retail sales report came out and it was very, very confusing, which is going to very much complicate the job of the Fed. August US retail sales rallies 0.1% compared to expectations of a decline of 0.2%. So retail sales coming in more, and then all of a sudden people are starting to say, wait, is the economy actually not that weak? Do we really need a 50 bips? So that piece of data alone is actually increasing the chances of a 25 bips rate cut. But wait, there's more. Core retail sales increased by 0.1%, missing the forecast gain of 0.2%. So that's the other one. So the day before we get this interest rate decision, we are now already getting more conflicting data that will only do is, I guess, just confuse the markets, the traders, the Feds themselves. So just to show you the volatility going into it. As of now, I just want you guys to know the current Fed fund rate's at 5.25%. On Wednesday, September 18th, like I said, I very much hope you're watching this in time. As of now, they think there's a 69% chance of a 50 bips rate cut and a 31% chance of a 25 bips rate cut. Now, this can change dramatically throughout the day, and I actually think this is a better way to look at it. But right here, by the end of this year, December 18th, the third row down, there's actually a 44% shot that we drop all the way down to 4%, as in a 1.25% cut between the September, November, and December meeting cumulatively. And then there's a 30% shot that we're at 4.25%, so 1%. So you can kind of see the different meetings and then the odds associated with them. But right now, they are pricing in, once again, a 7 in 10 chance of a 50 bips rate cut, but I just want to get this out there. I would not be surprised if it changes dramatically as we lead up to the actual event, but it's been a while since we've been this close to a decision and the markets have not made up their mind. And that uncertainty means that money's being bet on both, and one group is clearly going to be wrong. We can't have both. So whatever you do, yes, use all those stats, facts, and historic trends that I gave you, but also the name of the game is protect yourself. There's going to be large swings, a ton of volatility. Don't overbet and don't be silly. The final and most important thing I want to leave you with is right here. Once again, I fully understand this is only 2 data points, but I think it's actually really important. If Powell announces a 25 bips rate cut, do you think that the market could see a short relief rally? That's a fair question. Right now, it's one thing if we're trying to predict the 50 or 25, but a better question is how can we make money off of it? This would not be out of the norm. Recently, if you look at 2001 and 2007, on 2001, the day of the 25 bips rate cut, this day right here, where my cursor is, in one day, we went up 5%. The total pump before we actually started to sell off was 7.3%, and it lasted for 20 trading days, technically 19 trading days. So we had a full trading month of pretty green action, with the biggest one actually coming on the day of the announcement. Then fast forward to another somewhat similar example of 2007. The day of the cut, the market went up 2.9%. The total pump before the correction was 6.7%, and it lasted 17 trading days. So once again, I understand this is only 2 examples, and can you really make good projections off of it? No, but these are just, it's the best set of data we have. It's the most similar set of data we have. So I just want you to be aware of the bullish or bearish argument seems to be time frame dependent. In the short time frame, seems to be bullish, talking about the day and talking about the next trading month. But then the other data tells us that in the next 2 to 3 to 4 quarters, there are serious, noteworthy drawdowns in the market. So if you ask me, am I bullish or bearish? The answer is for what time frame? So I hope you can use this data. I hope you crush it. I hope you're watching in time. But whatever you're doing, man, things are about to get bonkers.